Assalamualaikum. In this video, I am going to share with you the computations for Hamidah Corp. The focus of the video is on cash budget. Now let's look at the informations given on Hamidah Corp. It is a distributing company selling herb-based sunscreens, and they have requested 40,000 US dollars, a 90-day loan from the bank to help them meeting cash requirements. They have problems of paying loans in the past, so the bank officer is scrutinizing their accounts and therefore wanting a cash budget for the quarter. So they have assembled the following data. On July 1st, that is the beginning of the third quarter, the company will have a cash balance of 44,500. And these are the sales, budgeted sales for September, for August and July, and actual sales for May and June. Based on past experience, it is shown that 25% of a month's sales are collected in the month of sales, meaning sales in the month of July will have a collection of 25% in the month of July itself, and 70% of July sales will be collected in August, and 3% of July sales will be collected in September, and the balance will be uncollectible. We have budgeted merchandise purchases and budgeted expense for the third quarter as given in the table for July, August and September. This merchandise purchases, salaries and wages, advertising, rent payments are all cash outflow, whereby depreciation is just an accounting expenses. These merchandise purchases, July, August, September, are paid in full during the month following purchase. What does it mean? It means purchases of July 240,000, the cash out will happen in August. 350,000 in total will be paid in September, whereby 175,000 in full will be paid in October. Accounts payable for merchandise purchases on June 30th, which will be paid during July, total 180,000. So in July, cash out will be 180,000 under the merchandise purchases column. We have more information. Equipment with a cost of 10,000 will be purchased for cash during July. There's cash outflow. And lastly, when they prepare the cash budget, there is this assumption of 40,000 loan, which the company will be making in July, and the payment is made in September. And there's this charges on the loan of 1,200. Let's prepare the cash budget. First, we prepare a schedule of expected cash collections for July, August and September, and also the total. So we have column July, column August, column September, and column quarter. From account receivable, mean sales, we are talking about July collection. It also includes sales from May of 3% of May sales. Yeah, and 70% of June sales will be collected in July, and 3% of of June sales will be collected in August. July sales. 25% of July sales will be collected in July. That is 100,000. 70% of July sales will be collected in August. And 3% of July sales will be collected only in September. Now let's look at August. August sales. 25% of August sales will be collected in August itself. And 70% of August sales will be collected in September. Let's look at September sales. 25% of September sales will be collected in September. So what happened to the 70% and 3%? All those will appear in the accounts receivable. What happened to 3% of August sales? That will also be in the account receivables. So to calculate for quarter, add up all this to give you 1.2685 million. July collection is 317,500. August collection will be 439. September will be 512,000. Now let's prepare the cash budget. There are 4 components of cash budget. One is the beginning, cash balance beginning. This section, collections from customers, total cash available. This one is the one section. We are interested to know the total cash available in the month. It has 2 components. One is the collection in the month itself. Another one is the beginning balance. Beginning balance of July means the ending balance of June. So we are interested with total cash available. In July, we have 362,000. The next segment that we are interested will be this. Cash disbursement. It means any cash out. We are interested with this figure. Total cash disbursement. So the first is the total cash available, all the cash in. The second part is the all cash out. Real cash. Depreciation will not appear here because depreciation are not real cash out. Those are just accounting expenses. So the third is this excess or deficiency of receipts over disbursement. 12,000 is different between cash available and expected total cash disbursement. In bracket would mean they don't have enough. They are deficit of 12,000. Okay. Here the same thing, yeah. In August, cash collection, total cash available, cash out for merchandise purchases, salaries, wages, advertising, rent payment. There. This is the difference between 467 and 444. This 535 minus all this. Remember I mentioned just now merchandise purchases. 240,000 of July merchandise purchases is paid in August. Yeah. And 350,000 August purchases is paid in September. What happened to the September merchandise purchases? It will appear in the accounts payable in the statement of financial position. Same thing that in September, all this adding to have to give you 479,000. The difference of this will give you this value. Okay, you don't straight away get to the 28,000 until and unless you have completed the whole 1 month computation. So A is the total cash available, B is the total cash disbursement, C is the deficiency or excess. Now D, the last part is this, the financing section. It simply tells you how do you finance the deficiency? Or what do you do with the excess? In this case, you were informed that there's a borrowing happened in July. So you record 40,000 borrowing. Kind of cash in, but it's not cash from operations. It's borrowing in nature. You borrow. Hamidah Care Corporation borrow. So one day they have to pay the loan. So in July, there's no repayment, there's no finance charges, total financing 40,000, cash ending balance 28,000. This 28,000 will be, as you can see here, will be brought forward here, 28,000. Calculate, right, go down, and there's no borrowing, no repayment, no finance charges, total financing, nothing at all. So you have the cash balance of 23,000. Look again, where's the 23,000? Here, the beginning of September. Go further down, you see that 56,000 excess cash. In that September, there's a repayment of 40,000, no borrowing. So total financing is half in bracket because there's cash out. And there's a 14,800 cash ending balance. You see here in the quarter means what? 1st July until 30th September. Okay, correct. So why do why do we have here 40,000? Because for the whole quarter only 40,000 borrowing. For the whole quarter only repayment of 40,000. For the whole quarter there's this interest or finance charges of 1,200. Yeah. So that give total financing of cash outflow 1,200 because borrowing and repayments cancel off. But let's look at this. Cash ending balance, you don't add up. Cash balance beginning means the beginning of the quarter. Remember, maju Sdn Bhd, the quarter means 1st July until 30th September. So what's the beginning of a quarter? 1st July. What's the cash balance 1st July? 44,500. But why do we add this and that? This is because these are the collections in the quarter itself. From 1st July until September 30th, these are the total cash collection. So total cash available in the quarter is 1.313 million. All these expenses, why you add? Because these are all cash out from starting 1st July until 30th September. The same thing. Add them up, go there. Add them up, 355. Add them up, 27,000. And that with the excess of 16,000. How do you get this one? It's 1.3 minus 1.297. So this is actually how we prepare the cash budget. And I hope you have understood the computation for Hamidah Care Corp and you can apply to more questions and exercises that you can find on budgeting. Thank you.